Hello and welcome, TrendSpider users, to session one of the GoNoGo Charts educational web series. And keep in mind, we have 6 short videos to not only help you understand the utility of GoNoGo Charts, but also some core concepts and technical analysis that will help you with your trading discipline. So my name is Tyler Wood. I am a CMT charter holder and the co-founder of GoNoGo Charts. And with me, as always, is my dear friend, Alex Cole. How are you?
Fantastic. Excited for this one.
Now, we've been working together for well over a decade, predominantly in education around concepts in technical analysis. But we just launched this company a couple of years ago and very excited about the implementation on TrendSpider that is now available. But our goal in putting this company together was to take everything that we have learned from institutional fund managers and research analysts and institutional traders and bring it to bear in the practice with investors of all experience levels. So this first session is really just a simple foundational introduction to the concepts of trend following. And many of this is going to feel quite familiar to you, but hopefully you'll start to think about things in a different way. So let's dive right in. Let's talk a little bit about what we're going to do in session one. But before we dig into methodology and tools, I want you to first think about how you feel about trading and whether or not you feel differently this year than you did last year, whether or not your trading rules or your discipline has changed. And I certainly feel like the end of 2021, we saw a lot of very exuberant, bullish excitement and people perhaps paying less attention to risk management. And really what it comes down to is that whatever your trading plan is, whatever your rules are, you have to develop a disciplined and repeatable process so that you're approaching markets with the exact same toolkit, no matter what the conditions are, and trying to remove some of that emotional bias and subjectivity. We know that consistent returns are going to come from a consistent, disciplined process that will help us avoid fear or greed. So let's talk a little bit about how we think of this process approach. Alex has a teenage son. For those of you in the New York City area, please feel free to stay off the roads while his 16-year-old is learning to drive. But we talked through this as a metaphor for how we think about trading and portfolio management. And that is that when you're first learning to drive, you have to have a checklist, a repeatable set of steps, an operating procedure, if you will, that will keep you safe. And you do these things the exact same way, no matter when you get behind the wheel, checking mirrors, keeping your foot on the brake before you engage the car into gear. All of those very rudimentary approaches are critical to keeping a driver safe, and of course, other drivers on the road as well. Now, in technical analysis, we could think about developing an approach, a process, and we could use any number of inputs, right? We could go all the way back to the beginning, starting to think about Dow theory, identify trend lines on charts. We could look for more classical chart patterns, as we learned in Edwards and McGee in the 1940s. We could use any number of indicators that have been developed largely by the CMT community, the 70s, 80s, and continuing today. And then, of course, we can look at lots of other core concepts between indicator divergence or looking at the investable universe on relative strength versus absolute trends. And the list goes on and on and on. The point being that when you are going to approach trading or running your portfolio, you want to have the same rules, this objective checklist for when you're going to enter a security and when you're going to get out. And those rules should be used consistently in the same. Whether you're in a bull market or a bear market, the security should meet your criteria to place that trade. So, Professor Cole, why don't you walk us through just a very simple concept of identifying trends?
Absolutely, I'd love to. And so I believe, and I think we both do, and I think a lot of people will argue that trend identification is the most important skill that we can learn as technicians. Because, of course, if we can identify a trend in price action, then we can profit on the majority of the move, right? We've heard the term making money in the meat of the market. We've any number of ways of saying this, where if we trade in the direction of the trend, on the side of the trend, we're going to be more successful. Now, of course, this is simple, but not easy. It's a simple concept, hard to execute. But what we want to do is just understand in which direction prices are moving. And we might start off just purely visually by looking at the chart and seeing if price is moving in any discernible direction. Now, of course, in hindsight, it's easy to say, yes, this one's moving from bottom left to top right. But at some point in the sort of third to the left, to the middle of this chart, we're starting to see higher highs, higher lows, and we can perhaps be identifying a new trend in the upward direction. Now, as technical analysts, we want to remove subjectivity and automate this process. So what might we do next? We're going to turn to our toolkit, and we're going to look at something like the Donchian channels. Now, these were created to look back at a period and ask whether or not price is at the highest point that it's been during that look back period. And if it is, we're going to move that red line up with these higher highs in price. And you can see again in that area there, in sort of in the third to middle area of the chart, a higher high, red line starting to move higher. And of course, the green line will be doing the same for the lows. So just using something as simple as the Donchian channel will allow us more easily, it'll draw our eye to these lines as they're moving higher. We'll be able to say we're seeing higher highs and higher lows. And we'll be able to identify that first one. Where did that one happen there as that red line moved higher? And if you're interested, look up the story of the turtle traders. They use Donchian channels. It's one of their primary entry points in that grand experiment created by Richard Dennis. Fantastic, fascinating story. I'd recommend everybody check that out if they haven't. But we'll move on from here, from that initial automating of higher highs and higher lows. We'll probably put a moving average on the chart because we believe it's inherently bullish if price is above a moving average. Because what does that tell us? It tells us that price right now has traded higher than the average of its prices over its historical time period, whatever we're looking at. Let's say this is a 20-period moving average. If price has crossed above that level, then it's moving higher than the 20-period average of those prices. Very important, valuable information. And as we know, Tyler, we've seen a number of charts. If one average is good, 2, 3, 4, how many more averages can we put on a chart? We've seen moving average ribbons where you can just see fans of moving averages. And of course, maybe they have their place, but we'll definitely see a lot of people adding a second moving average, and they'll look at the interplay between a short moving average and a long moving average. And we call that the moving average crossover. And every time that short moving average crosses over its longer moving average, that's important information because that tells us that prices in the shorter term, and again, just using that average instead of price itself smooths out our information. We know that prices in the shorter term are moving up higher than prices over the longer term. And that looking for that bullish cross, of course, can give us that confirmation that prices are starting to trend. But let's move on and continue to build this checklist. Remember, we're trying to create a disciplined process that will help us remove doubt. So we might add something like the Bollinger Bands to this. John Bollinger created these fantastic indicators, really trying to understand volatility and the role that plays in price action. And we know that the bands are created by using standard deviations around the mean. So the traditional use of the bands is to plot two standard deviations above and below an average of price. And from our way back in the past times of math classes, we know that two standard deviations around a mean will encompass roughly 95% of the data if that data set is normally distributed. So anything outside of those bands is going to be really, really important information. And of course, we must note that financial data is not normally distributed, but anytime price is pushing up against those bands or breaking just above the bands, that's an unusual occurrence, right? So we want to pay attention to those moments. And one of the interpretations of a Bollinger Band is if it trades up and out, then we trade in that direction. And so again, in that same sort of area, we see price trading right up to that Bollinger Band and perhaps riding those bands a little bit, and that pushes price higher. But we wouldn't stop there. No, I don't think anybody would. We'd continue to add information to build our weight of the evidence approach. So we could look at something like the volume chart that we've seen from Charles Dow and way back in the old beginning times of technical analysis. Volume is used as a confirmatory tool and getting that sense of if market is participating in the movements of price, that can add weight to our opinion as well. And let's just throw one more on here, because I'm sure that you've seen charts with lower panels, indicators in the lower panels, and not just one, but several. And that, of course, can give us more information as well. And one of the most used is the MACD, the moving average convergence divergence indicator. And of course, that looks at the difference between moving averages. So that gives us a sense of trend, but also kind of a momentum idea as it oscillates within its range. So we can look at the MACD and also put its signal line on there and say if the MACD is crossing above its signal, or if it's crossing above the zero line into positive territory. Those are also bullish situations. And now we're stacking one thing on top of another to give us that confidence to suggest that somewhere in there, in that middle third area, there you go, there's the annotation to highlight it. Somewhere in that period, we'd be confident telling a client we're starting to see a trend in the upward direction. But of course, where in that circle would we be saying we'd be confident that we've seen a trend?
Well, and there you're starting to identify the challenge. We believe the technical tools are incredibly powerful, and using them in conjunction, a multi-factor approach to give yourself a more robust and conclusive set of evidence that indeed the trend is there and ready to participate in. But we're outlining over a month of trading in that blue circle area, and we've also seen that this is a relatively simple checklist. We've got 6 or 7 tools, and we haven't overloaded our chart by any means. As Alex and I have worked with young entrants and new practitioners of technical analysis, you'll start to see charts like this. And there are 2 problems. One is the indicator overload, right? We develop analysis paralysis, because even in a 6-point checklist, are you waiting for all 6 to confirm that trend has begun? By the time they do, sometimes that trend is already over, and you're starting to see evidence appear that it's time to exit the trend. The second problem with technical analysis practitioners is that when we use so many of these tools, the data visualization itself becomes quite cumbersome. And remember, the most important indicator of all is price. Only price pays. And if we obstruct our view of what's happening with price action, we're unable to see important areas of support and resistance. We're unable to do any of that classical technical analysis and keep our eye on what's actually happening trading in the market. So this problem can be solved. And that was one of the things that we set out to do with GoNoGo Charts, was to compile all of the weight of the evidence, have that confluence of multiple indicators, multiple concepts that give us a robust understanding of trend. And the name of the company, Go or No Go, comes from that NASA nomenclature of pass-fail system. If you're going to put billions of dollars of hardware into space, you want to make sure that the conditions are optimal before you launch that rocket. So if you're a long-only investor, you're looking for go trends. If you also trade to the short side, you'll be looking for no-go trends. And just real quick review for those of you who are new to the chart structure. We're taking that weight of the evidence, all of those indicators, compiling those in the background, and then painting the candles of our chart, or bars if you choose, to indicate the strength and direction of the trend. So in a go trend, we have the strong form of upward trending conditions in these blue candles. We have the weaker form in the aqua candles. In no-go trends, a strong form downtrend is in purple bars or candles, and the weaker form of the no-go trend is in pink. Now, Alex and I are incredible fans. We're taken with the life and works of Jesse Livermore, who's very famously quoted as saying, in all markets, there's a time to go long, a time to go short, and a time to go fishing. So sometimes the market is going to give us conditions of uncertainty or neutral readings across all of those indicators. And when that happens, when they all fall to zero, when they're in neutral territory, we paint the bars or candles in this amber color. And those are the go fish bars, because sometimes that's the signal in and of itself when the market is chopping around and really not displaying a directional trend in either way. So we're extremely proud of the work. We feel that the data visualization of core concepts and technical analysis could be helpful to traders of all sizes and all levels of experience, and certainly with all of our institutional clients as well, to get a complete understanding of the trend construction, but with a simplified visual. And for that, we're just giving it away for free. We want to make sure that everybody can get their hands on these tools. And so in TrendSpider, you can add this indicator right now. Just go to your chart, manage the indicators, and just look up GoNoGo Trend. That is the free version that is available to all TrendSpider users. And the only thing that we would ask in return is that you let us know how it's working for you. What time period are you trading? What securities do you like to trade? Has it changed the way you feel about markets? And has it helped you make more timely decisions? And for that, please, by all means, shoot us a note at info@GoNoGoCharts.com. And remember, there's 5 more of these videos in the series, and we'll be walking through more concepts and tools in the complete GoNoGo chart as we move forward. Until then, take care of each other and trade them well.